You've got $100,000 to invest, but here's the problem. You're stuck in analysis not knowing where to go. With so many options out there, stocks, bonds, real estate, it's hard to know what the right move is. You might be thinking a safer option like a savings account sounds better, but here's the problem. While it feels safe, it's actually costing you in the long run because inflation is eating into your savings. But what if you took that $100,000 and spread it across 5 carefully selected Schwab ETFs? In this video, I'll walk you through the 5 best Schwab ETFs and explore how each could grow your investment over the next 10, 20, and even 30 years. In the end, I'll show you and John how these funds can transform your $100,000 investment into $5 million, which pays over $200,000 in annual dividends. That's over $20,000 in monthly dividend income. When it comes to investing, Charles Schwab is known for its commitment to providing low-cost and accessible investment options. Schwab's ETFs have gained popularity due to their broad market exposure, low expense ratios, and strong track record of performance. The 5 Schwab ETFs chosen represent a balance of growth, stability, and income generation. Each fund offers unique advantages, from tapping into broad market trends to focusing on high-quality dividend payers. This selection provides a diverse investment strategy, helping you and John maximize returns while managing risk through well-rounded exposure across various sectors and market cap sizes. Let's start the list, ranked in descending order of their unique benefits and growth potential. Starting at number 5, I have the Schwab US Broad Market ETF with the ticker symbol SCHB. This ETF is designed to provide exposure to the entire U.S. stock market. With over 2,400 holdings, SCHB offers a diversified portfolio including sectors like technology, financials, and healthcare. Technology makes up the largest slice of the fund at 31.59%, followed by financials at 13.36% and healthcare at 11.43%. This composition provides a balance of growth-driven tech companies and the more stable financial sector. Among its top holdings are Apple, Microsoft, and Nvidia, which together form a significant part of the fund's 30.29% in its top 10 holdings. SCHB's performance is backed by solid momentum metrics, earning an A- grade. The ETF has delivered a 1-year total return of 37.64% and a 5-year total return of 106.29%, showcasing its ability to generate consistent growth. Even more promising is its 5-year price performance of 90.48%. In terms of dividends, SCHB's yield stands at 1.21%. While this might seem modest compared to some other income-focused ETFs, the fund's real strength lies in its potential for long-term appreciation. The ETF's 10-year dividend CAGR of 6.86% suggests that payouts have grown steadily, adding to the overall return potential. With 14 consecutive years of dividend payments, SCHB has proven its reliability as a steady income generator for investors looking to balance growth with income. Now, what happens if you and John invest $100,000 in SCHB? Given its historical average annual return of 11.42%, your investment could grow to approximately $112,630 in just 1 year. After 10 years, you might see your investment rise to $322,130. If you're willing to stay invested for 20 years, the portfolio could rise to about $1,004,113, driven by both capital appreciation and reinvested dividends. By the 30-year mark, your initial $100,000 investment could reach a portfolio value of $3,065,873. Paying $8,577 in annual dividends. So this $3 million might seem huge for you, but I have a Schwab ETF that can turn your investment to more than $4 million that pays over $20,000 in monthly dividend income. Stay tuned until the end to find out. Next, I have the Schwab US Large-Cap ETF, ticker symbol SCHX. This fund is tailored for those who want exposure to some of the largest and most stable companies in the U.S. market. With a concentrated portfolio of 755 holdings, SCHX emphasizes blue-chip stocks that have a strong track record of performance. Technology stocks dominate the fund's allocation at 32.78%, followed by financials at 13.12% and healthcare at 11.23%. Major players like Apple, Microsoft, and Nvidia are among the top holdings, which together with Amazon and Meta Platforms make up about 32.51% of the fund's total assets. SCHX competes with other large-cap-focused ETFs like the John Hancock Multi-Factor Large-Cap ETF with a 0.29% expense ratio and the iShares Russell Top 200 ETF with 0.15%. Compared to these peers, this ETF stands out with its ultra-low fees, offering a competitive edge in cost management. Its momentum is reflected in its impressive performance metrics, with an A grade for its 3-year total return of 33.35% and a 5-year total return of 110.69%. The ETF has consistently outperformed broader market averages. The ETF's expense ratio is a competitive 0.03%, allowing investors to benefit from its growth without high costs eating into their returns. On the dividend side, SCHX offers a yield of 1.2%. Its 10-year dividend CAGR stands at 7.08%, indicating consistent growth in dividend payouts over time. Although the yield may not attract income-focused investors initially, the steady increase in dividends makes SCHX a good choice for those who want both growth and a growing income stream. The ETF has maintained 14 years of consecutive dividend payments, demonstrating stability and reliability in providing returns to its shareholders. Now let's put yours and John's $100,000 into SCHX. With its historic average annual return of 11.79%, your investment could grow to approximately $112,990 after 1 year. After a decade, you could see your investment swell to $332,464, driven by a mix of capital gains and reinvested dividends. If you keep the investment for 20 years, the portfolio might grow to around $1,069,286. By year 30, the investment could reach $3,369,247, with dividend reinvestment adding over $118,509 to the total. The annual dividend income could reach approximately $8,903, while the overall value added from capital growth and dividends would be about $3,269,247. The next ETF on my list is one with a more fundamental approach, the Schwab Fundamental US Broad Market ETF, with the ticker symbol FNDB. This ETF offers a unique twist by focusing on companies selected based on fundamental metrics rather than market capitalization. Its approach emphasizes factors like revenue, cash flow, and dividends, aiming to capture value and income opportunities within the U.S. market. With over 1,700 holdings, this ETF is diversified across sectors, including financials, which is 18.46%, technology, which is 16.9%, and healthcare, which is 11.14%. It holds a mix of established giants like Apple and Microsoft, alongside value-oriented companies like JP Chase and ExxonMobil. FNDB's performance reflects its balanced approach with a B+ momentum grade and strong 5-year total returns of 102.26%. The ETF has outpaced many of its peers, achieving a 3-year price performance of 28.39%. Although its expense ratio is slightly higher at 0.25%, FNDB's strategy focuses on capturing long-term growth while maintaining a solid value orientation, making it appealing to investors who are willing to pay a little bit more for a differentiated approach to market exposure. Dividends play a central role in FNDB's appeal, offering a yield of 1.66%. The ETF's 10-year dividend CAGR of 12.48% shows strong growth in payouts, making it suitable for investors looking to build an income-generating portfolio. With 10 consecutive years of dividend payments, FNDB has a track record of providing consistent returns to its shareholders, making it a stable option for those seeking a mix of value and income. So if you and John invest $100,000 in this ETF, what could you and John expect? With an average annual return of 9.92%, your initial investment might grow to approximately $111,580 after 1 year. Over 10 years, the investment could reach around $304,669, supported by both capital gains and reinvested dividends. After 20 years, the value will rise to $973,736, and by 30 years, the portfolio could be worth approximately $3,308,803, paying $100,838 in annual dividends, or roughly $8,403 in monthly dividend income. This $8,000 seems good, but there's a Schwab ETF that can turn your investment to more than $4 million, which pays over $20,000 in monthly dividend income. Stay tuned till the end to find out which one. Let's move forward to another ETF that only focuses on large cap value, the Schwab Fundamental US Large Company ETF, with the ticker symbol FNDX. This ETF is designed for those who want to focus on larger companies using a fundamentally weighted methodology. This ETF includes 737 holdings and emphasizes financials, which is 18.64%, technology, which is 17.3%, and healthcare, which is 11.48%. Its largest investments include Apple, Microsoft, and Berkshire Hathaway, which together with other top holdings like ExxonMobil and JP Morgan Chase make up 20.08% of the fund's total assets. The performance of FNDX is strong, with a B+ momentum grade and notable 5-year total returns of 104.6%. Its focus on fundamentals has enabled it to achieve a 3-year price performance of 29.82%, suggesting it performs well in a variety of market conditions. With an expense ratio of 0.25%, FNDX offers an attractive cost structure for those looking to diversify their exposure to large-cap stocks, while relying on fundamental data for stock selection. FNDX's dividend yield stands at 1.68%, with a 10-year dividend CAGR of 13.3%. With 10 consecutive years of dividend payments, FNDX has proven itself as a reliable choice for long-term investors. So what happens if you and John invest $100,000 in FNDX? With an average annual return of 10.08%, your investment could grow to approximately $111,760 after just 1 year. After 10 years, it has the potential to reach $311,290, driven by constant capital appreciation and reinvested dividends. Holding the investment for 20 years could see the value rise to about $1,033,622, while a 30-year horizon could result in a portfolio worth $3,747,539. Meanwhile, paying $138,100 in annual dividends, or about $11,508 in monthly dividend income. The total value added to your portfolio will be around $3,647,539, with $931,246 from reinvested dividends and $2,716,293 from capital gains. Finally, at number 1, topping our list, is the Schwab US Dividend Equity ETF with the ticker symbol SCHD. This ETF is a go-to choice for income-seeking investors like me. The ETF focuses on high-quality U.S. companies with strong dividend histories, offering both stability and income. With 103 holdings, SCHD allocates a significant portion to financials, healthcare, and consumer defensive sectors. Its top 10 holdings, including giants like Home Depot, Cisco Systems, and Pfizer, make up 40.82% of the fund's assets, ensuring a concentrated yet diversified exposure to dividend-paying stocks. SCHD is positioned against dividend-focused ETFs like the Vanguard High Dividend Yield Index Fund ETF, with a similar expense ratio of 0.06%. And the iShares Core Dividend Growth ETF at 0.08%. SCHD stands out for its strong focus on both dividend yield and growth potential, making it a solid choice for income-oriented investors. SCHD's focus on dividends is reflected in its A+ dividend grade, with a current yield of 3.39%. This makes it an attractive option for investors looking for immediate income from their investments. Additionally, it also has a dividend compounding growth of 11.13%, highlighting the ETF's potential for growing income over time. With 12 consecutive years of dividend growth and payments, SCHD stands out as a reliable option for those who prioritize income stability. While SCHD may focus primarily on dividends, it also offers capital appreciation with an average annual return of 8.74%. This balanced approach allows investors to enjoy regular income while benefiting from market growth. So what can you and John expect if you invest $100,000 in SCHD? Well, after 1 year, your investment could grow to around $112,130. In 10 years, the investment might reach $325,268. If you hold SCHD for 20 years, your portfolio could grow to $1,156,538, benefiting from the compounding effect of reinvested dividends. After 30 years, the investment could be worth an impressive $4,598,008, this time paying around $267,787 in annual dividends, or about $22,316 in monthly dividend income. The total value added to your portfolio will be $4,498,008, with $1,798,481 coming from reinvested dividends and $2,699,527 from capital appreciation, making it the top dog of Schwab ETFs. Question: do you prefer growth over dividends? Click the video on the screen to find out how to turn a $100,000 investment into a portfolio valued at over $20 million.